In the second week of July 2026, two simultaneous events in New York and Tokyo signaled a change in how global capital is allocated. On Wall Street, the South Korean semiconductor giant SK Hynix executed a record-breaking $26.5 billion mega IPO through American depositary receipts. This capital raise serves as a benchmark for the scale of funding required to build out global artificial intelligence infrastructure. Simultaneously in Tokyo, Japan's Finance Minister Satsuki Katayama pressed the $1.8 trillion government pension investment fund to significantly increase its domestic holdings. We are observing two distinct engines: U.S. growth powered by AI infrastructure and a state-led repatriation of Japanese capital. These events suggest that the previous market environment, defined by low interest rates and simple yield gaps, has been replaced by a different set of economic drivers. This shift has created a visible contradiction. Interest rates remain in restrictive territory, yet equity indices are reaching all-time highs. While equity markets are rising, professional debt markets show a significant divergence in how they are pricing long-term credit risk. To analyze this divergence, we use the valuation equation. Price equals earnings per share multiplied by the price-to-earnings ratio. By deconstructing the denominator into the risk-free rate plus the equity risk premium, we identify what supports current prices and where risks are underestimated. Without mapping this macroeconomic data into these specific factors, it is difficult to determine if current valuations are sustainable. We start with RF, the risk-free rate, sitting in the denominator of our valuation model. The U.S. 10-year Treasury yield has climbed to 4.568%, yet interest rate futures price in a 25% chance of a July rate hike, reflecting a market expecting the Fed to pivot toward cuts. The upcoming June CPI data will test this expectation. A recent decline in gasoline prices is likely to drag down the headline inflation number. However, the core CPI, which excludes energy, remains at 2.9%, driven by persistent inflation in services and shelter. This persistent core inflation is why the new Federal Reserve Chair, Kevin Warsh, is moving away from the previous administration's approach. Warsh has formed a task force that includes former Bank of England Governor Mervyn King, signaling a shift toward prioritizing structural inflation and productivity gains over short-term market expectations. Removing forward guidance from the latest FOMC statement signals the Fed will maintain higher rates for a longer duration to ensure price stability. Mathematically, this means the risk-free rate will likely remain a drag on the price-to-earnings ratio for the foreseeable future. Next, we look at RP, the equity risk premium, using the credit markets as a proxy for how risk is being priced. U.S. high-yield option-adjusted spreads have compressed to 2.70%, a level that historically indicates high levels of investor optimism. Access to capital appears high, with the Dealer Track Credit Index reaching a 10-year peak. However, there is a strict distinction between liquidity, the current availability of funds, and solvency, the ability of a business to sustain its debt over time. High interest rates increase debt servicing costs for smaller zombie companies not benefiting from the AI growth cycle, putting their long-term solvency at risk. If credit markets eventually reprice this risk, the equity risk premium will rise, leading to a sharp reduction in market-wide valuations. If both the risk-free rate and the risk premium are pressuring valuations, why has the market not corrected? We find the answer in the first half of the equation, earnings per share, and specifically the growth variable, GE. The SK Hynix IPO shows how this growth is manifesting as physical infrastructure. The capital expenditure for AI, factories, cooling systems, and data centers is acting as a significant stimulus for the broader economy. This creates a no-landing scenario, where strong aggregate demand allows the economy to continue growing even as interest rates and inflation remain elevated. The rapid earnings growth of a small number of AI-related companies is currently offsetting the solvency risks building in other sectors of the market. While AI drives the U.S. side, a different variable is emerging in Japan, a reversal in capital flows. The geographic center of this change is Tokyo. The Bank of Japan raised its policy rate to 1.0%, supported by 3.2% nominal wage growth and a transition toward demand-driven inflation. The Takaichi administration is backing this with a mandate to finance 370 trillion yen in domestic growth, reversing decades of capital leaving the country. If the GPIF begins to shift even a small percentage of its $1.8 trillion portfolio back to domestic assets, it will create a significant demand for the Japanese yen. Japan's real effective exchange rate sits at a historic low. This capital repatriation would provide the necessary flow to cause a sharp currency appreciation. Investors can no longer assume that a weak yen will continue to support Japanese exports. They must now factor in a regime of capital repatriation. We are seeing two primary drivers in the global economy: U.S. AI expenditure driving demand, and Japanese structural reform driving capital back home. In contrast, regions like the UK and Europe are facing different challenges, with the UK's Office for Budget Responsibility warning that public debt levels may soon require significant tax increases. This global macro allocation matrix evaluates regions by growth, inflation, and policy alignment. We prioritize assets benefiting from these drivers, specifically U.S. AI infrastructure and Japanese financials. Conversely, sectors vulnerable to high rates and currency shifts, like U.S. high yield and Japanese exporters, face higher risks. Tactical adjustments include hedging against higher U.S. rates ahead of Fed testimony and taking a long position on the Japanese yen. Understanding these valuation variables is the only way to manage risk before the next set of CPI data is released. For the full technical strategy, visit the Alpha Beta Research Portal.